John, let me first ask you what you expect from the Fed today. Do you expect us to get really any details as far as the balance sheet unwind?
I think they've given us quite a lot of hints already, but this meeting is not likely to be a meeting where we see much in the way of new policy announcements. Typically, they'll give us more detail when they do a press conference, which will be at the next meeting. So I think the market's expecting very little, maybe some changes to the statement language with regard to things like inflation, but I think that's been well flagged. So not a lot at this stage.
So when we saw something like the bond sell-off yesterday, really globally, what does that say to you? Was the market positioned wrong, or are they just girding for something unlikely, a gray swan, so to speak?
Our sense is it's not necessarily that connected to the Fed. So we've seen quite a lot of better than expected data in the recent past. Obviously, Europe, we had the IFO yesterday. We've had better data out of the States after a pretty long run of disappointing data. And the market had obviously rallied over recent weeks. So our sense is that maybe it had got a bit ahead of itself. It had essentially priced out most of the chance of further rate hikes this year and into next year. And so it maybe got a bit overdone and the data's turned. And so perhaps it's not surprising that yields are a bit higher.
Have a look at this chart, John. This is the financial conditions in the white line. I mean, they are the easiest since 2014. That's going back to the highs of 2007. My question to you is, we've had 100 basis points of tightening from the Federal Reserve. Should I be more concerned that I've got such easy financial conditions and minutiae of rate hikes and still no driving force of reflation, really?
Well, the inflation point is interesting. I mean, I think the Fed are troubled to some extent by the lack of inflation. I mean, certainly the economy looks to be working pretty much at full employment. Most of the data suggests that, if anything, there's shortage of skilled employment in certain areas. But that hasn't really fed through to higher wages or higher inflation. We would argue that some of the things that they're looking at, or that are causing inflation to be soft, are transitory, and the Fed would agree with that. The question is there more to it than that? And our sense is that we will begin to see gradual inflation coming back through next year, particularly if the dollar remains somewhat softer. And so the reason for the Fed holding off next year, I think, will be less apparent, particularly if they're also now concerned that easy financial conditions actually cause some froth in markets over time.